Okay, hi Vic, Simon Drew here again for round two. Just to give you a brief introduction from Southern Cross Care, a non-for-profit organisation, and the problem is looking at what do you do with large cash reserves and no debt. So in effect, how to optimise their reserves whilst adhering to their core values, and that is to deliver contemporary care to the elderly and having longevity in mind. In order to look at this scenario, I've had a look at a project that involves building a new residential aged care facility over a 25-year time frame with those cash returns. So in effect, I'm looking at a framework for a capital management strategy. Okay, now in order to do this and to set up the scenario, I need to look at a number of different financial instruments, namely the weighted average cost of capital. So I'm looking at the WACC. Okay, but rather than just plucking a figure from the literature and putting that into the NPV analysis, I took a different approach, that by looking at the formula and the various components of that formula and how those different components of the formula relate to the aged care sector. So in doing that, what I've actually done is I've looked at the cost of equity and I've calculated that specific to the project, and I've also looked at the cost of debt specific to the project. So the cost of equity being the required rate of return paid to the equity investors. And this is intimately linked and associated with risk as well. And this has been fleshed out within the report. So looking at the CAPM model used to determine the estimated return over a 25-year time frame, and that 25-year time frame is explained in the report as to why I've used that. I've looked at the formula, okay, and again I've looked at the various components in that formula and calculated each of those components individually before getting the final result. So the results being the risk-free rate was determined at 2.3%, the equity market risk premium was 6%, the beta value, which has been quite difficult to find, was at 1.1, and this is directly related to a ASX listed aged care provider with a similar portfolio to, say, Southern Cross Care. The specific risk premium was calculated at 1%. So what was the result? The required return on equity was derived at 10%. That then led me into looking at the cost of debt, and this was a far easier calculation to have a look at, where the indicative borrowing rate is 4% and the Australian company tax rate is 30%. So the cost of debt was calculated at 2.8%, which is actually quite low and reflective of current times. When you plug all of those figures in, the weighted average cost of capital was calculated at 5.68%. Now, rather than just kind of jumping ahead and throwing that calculation into my NPV analysis, I actually did a bit of an industry comparison within the literature. And what was quite outstanding was the various values that have been used within the literature, say over a 15-year time frame, anywhere from 7.1% to 20%. It's been proposed that the industry benchmark is actually 12%. Had I just used 12%, I would have actually underestimated the value of the project. So it just highlights that it's not a case of just using a figure and chucking that in. It's a matter of actually looking at that formula, and more in particular, it's the inputs that actually go into the formula that are critical in order to establish an accurate calculation. So, and this is largely due to because the WACC is a reflection of all the activities and risks that would be explicit to not only the organisation but also the project. For example, what was the funding strategy and what was the leverage ratio of debt versus equity? Okay, so that gave me a good foundation as to why I've actually used that value, but it also had me explore what is the optimal capital structure. Sorry, I'm getting a bit of glare coming in from the sun there this morning, so sorry Vic, you'll have to manage with that one. So it had me looked at what is optimal capital structure, and this had me delving into the literature where there is just a vast body of it that exists, and a lot of controversy as to whether an optimal capital structure does actually exist. Can you find that sweet spot in terms of how much debt versus equity? On the surface, one would look at the perfect ratio of saying, well, debt is cheap, it's less risky, so why wouldn't you just leverage with a ton of debt? Well, unfortunately, the more debt you get, the inherent degree of risk that is associated with that. With the increased risk, would require an increased return to those investors as well. So some argue that the WACC is a bit of a fallacy, or the optimal capital structure is a bit of a fallacy. So moving forward with the project, I was quite comfortable with my 60-40 ratio, and this was the recommendation that was given to me by our CFO. But not only that, it's actually representative of what occurs within the industry, particularly with the non-for-profits and their risk profile that they're prepared to take. Nevertheless, I will actually do a bit of a sensitivity analysis and adjust and play around with the WACC value, as well as the debt versus equity ratios as well. Okay, so I just wanted to highlight that it wasn't just a case of plucking the WACC and running with it. What this project has had me do is really investigate and delve into the WACC and what that represents, and how that correlates not only to the project but also to the industry as well. So that gets me on to the NPV analysis, and this was actually quite a detailed component to the report, and it's something that I'm fairly proud of because it's required developing some Excel spreadsheet skills, and in order to do that, I've had to really look at a number of different assumptions. Okay, I've had to identify all the various cash flows, and in particular for this scenario, I've just looked at the capital cash flows, okay, rather than looking at operating cash flows. As a non-for-profit organisation, part of our mission or our business strategy per se is that any operating cash flows won't be generated as a revenue profit scenario, but rather a break even. That's saying any operational cash flows we generate is generally offset by the cost of care that is delivered. Okay, so hence the focus was solely on capital cash flows. Now, in order to determine whether the investment was appropriate, it needed to have the return being greater than that of the cost of capital and also the associated risk. So the basic assumption that was put forward was accept the project if the NPV is greater than 1 or positive. The break-even point is if the NPV is equivalent to 0. I also looked at the internal rate of return, and of course you would accept the project if the internal rate of return was greater than that of the WACC. So what were the various cost elements? I had to look at the cash ins and the cash outs. Now this is explored in a lot of detail within the report, and I won't go into that today. So basically I looked at the construction costs and some of the assumptions that were linked with that. So the construction cost was $250,000 per bed, and that the building value at the end of the 25-year term was equivalent to 0. Now, looking at the cash inflows, the major cash inflow is related to accommodation bonds. Okay, it's basically an interest-free loan from the customer. Now, this is actually quite a complex situation that I go into a lot of detail in the report as well. Okay, but it's the interest that is used for capital investment as a result of those bonds. So for every room, the accommodation bond was set at $500,000. The assumption is that we have 80 beds at 100% occupancy, which is equivalent to a $40 million bond retention. So in summary, the key assumptions were a 25-year time frame, $20 million construction cost. The equity versus debt ratio was 40 to 60. The number of beds was 80. The accommodation bond, or the RAD, was set at 500,000. Debt interest was at 4%. The repayment term over 12 years. And this is the clincher, this is the key component, was the investment return expected at 9%. Well, that's the current investment return that Southern Cross Care have as part of our investment portfolio. The WACC was set at 5.68%. The result was that the internal rate of return was 213%, clearly greater than 5.68%, and therefore the project accepted, and the NPV was positive at 37 million. So you can see why aged care is a bit of a booming industry, and you can see why there's a lot of private equities getting into the market, because there is money to be had and to be distributed amongst the shareholders. Now, in terms of the discussion, the key component of the NPV and the financial management of the project lies at the heart of the debt interest ratio versus the investment return. So at the moment, debt interest is fixed, okay? However, the investment return, it fluctuates, and that's what requires close scrutiny. If you had the debt interest set at 4% and also the investment return set at 4%, you would have an internal rate of return equivalent to 0. So it's basically the difference between those two values that really drives the internal rate of return, and this is what is at the heart of the problem. Okay, it's the investment strategy of those accommodation bonds that really determines the success. Okay, had we been conservative and placed the accommodation bonds into an authorised deposit institute, the likely return would be set at 2%. The required, however, as part of Southern Cross's strategy and what I'm putting forward, is that we put it into an investment portfolio that is a registered management investment scheme, and that is set currently at 9%. So effectively what I've uncovered is what is the risk appetite for a non-for-profit organisation, and specifically what is the risk appetite for Southern Cross Care. Because what that does is that requires an investment management strategy that is closely scrutinised. So what I need to do now is a bit of a sensitivity analysis where I can play with some of those figures that sit in my spreadsheet. But what I've already had a quick look at is what would be the investment return required if I set the MPV at 0, and that was calculated at 7.89%. High risk, high return, and this is what I'm going to discuss further in my report. Thank you.